Hello again, this is your weekly US market news summary from Ferrari Financial. Well, last week we predicted a possible breakout at the end of a triangular consolidation pattern that's been forming over the last few weeks. And this week we saw that breakout, and as we predicted, it was to the downside. In fact, at one point on Friday night, the Nasdaq index was penetrated below the 2,200 level. This is quite a key support level. This was the support level back at the last major sell-off, where the market bounced back quite well from this point. Whether it will do so again this time is open to question. Our feeling is that possibly next week we will see a little bit of a recovery effort, but we do think this is going to be short-lived unless there's some major good economic news or something that really changes the horizon for the market at the moment. Economic advisors to President Bush said this week that they felt there would be a possibility of a negative growth figure for the US economy this first quarter. If the market does in fact slip further from this point, it really does spell bad news for the general investing community, because really since the November slide there's been no chance to get out at a reasonable price. The market did slide considerably, consolidate for a while, and is now started sliding again. Let's take a look at our Nasdaq chart. We're going to take a look at the 1-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks, where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark. At 2,208 was the worst level before we had the pullback that we've had in the last week or so, on the promise of a nice fiscal package with some tax cuts, and of course the Federal Reserve stepping in with an interim interest rate cut, followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak, and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, and one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback or consolidation over the next few weeks, before then the market would probably turn southwards again. Two other important factors are certainly not helping the US economic outlook, namely the extreme weakness of the US dollar. At the moment, we've got the euro trading against the dollar at 153, which is really a historical low for the dollar against the euro. And of course, the price of oil is also really causing problems, as it's hovering around the $103 to the barrel level. And of course, it is the fact that oil is traded in US dollars that is causing the oil price to stay at such elevated levels. The trouble is now that if you were to go down the investor's wish list and tick off all of the various items, there would be nothing to tick, because simply all the major factors which normally are the engine of increased investor returns, such as property prices, the fact that companies are growing, the economic growth in the country is healthy and sustainable. Other major factors, such as people still have plenty of credit, they can still spend more money with credit cards or take on more debt in the way of loans and spend money and boost the economy that way. All of these factors have evaporated in the last 6 months. Manufacturing indexes have also fallen recently, and consumer spending figures, and most important of all, probably for the Americans, the consumer confidence level has dropped drastically in the last 2 to 3 weeks. In fact, the only real piece of encouragement I can give investors at the moment is that the stock market always looks ahead, and if it feels that this recession is going to be short and sharp, it could well price in a recovery towards the end of the year. And this could result in a market upturn sooner rather than later. Until next week, it's goodbye from London.